So last time we talked about how modern finance came up with this really elegant way to price risk, right? It was called equilibrium. And it was this powerful idea, but, well, it rested on some pretty shaky assumptions. And that led to a huge fork in the road. So what was the alternative? That's exactly what we're going to dig into today. And really, it all comes down to this one question. If that perfect, idealized world of equilibrium is just too much to ask for, is there another principle, something simpler, more robust, that can still keep markets in line and price risk? Is arbitrage actually enough? To really get why this question became so important, you first have to see the cracks that were starting to show in that beautiful structure of equilibrium theory. I mean, you can't deny it, the equilibrium models were a huge breakthrough. They gave us this clean, intuitive idea that an asset's expected return was all about how it moved with the market as a whole. It made sense, you know? It was intellectually really satisfying. But, and this is a really big but, it all depended on some assumptions that are frankly pretty hard to swallow in the real world. You had to believe in this single representative investor who somehow acts for all of us. You had to assume that every single person has the exact same beliefs about the future. Oh, and it required a market portfolio that contains every single asset in the world, something we can literally never observe. So what happens when those foundations start to crumble? When you realize the real world doesn't look like that at all? Does the whole idea of rational pricing just fall apart? Or is there a simpler way to keep prices from going completely off the rails?
And that leads us to the powerful alternative that came next. Instead of assuming this perfect top-down market coordination, economists started focusing on a much, much simpler idea, the principle of no arbitrage.
So what is arbitrage? Well, put simply, it's the ultimate free lunch. It's that chance to make a guaranteed, completely risk-free profit just by spotting a price difference. You know, buying a stock for $1 on one exchange and instantly selling it for $1.01 on another. It's riskless money. This is really the core logic right here. It's often called the law of one price. Think about it. If two different things promise the exact same payout down the road, they have to cost the same today. Why? Because if they didn't, traders would pile in, they'd buy the cheap one, sell the expensive one, and make a riskless profit. And in doing so, they'd force the prices right back together. The opportunity would vanish. And you can really see the shift in thinking here. Equilibrium theory is this grand top-down story about how everyone's individual preferences all magically coordinate to set prices. Arbitrage, on the other hand, is a bottom-up story about discipline. It doesn't care what you believe or what your preferences are. It just says that obvious risk-free profits can't stick around. It's a much less demanding, and you could argue, a much more realistic foundation for how prices are set. Okay, so let's see how this simple idea, no free lunches, gets built up into a formal model. This is what became known as arbitrage pricing theory, or APT for short. And the logic is actually pretty straightforward. First, you assume that returns are driven by big, systematic risk factors, things like surprise jumps in inflation or unexpected changes in industrial production. Second, if any asset's price gets out of whack with its exposure to these factors, sharp-eyed traders, the arbitrageurs, will jump on it. The result? Expected returns have to line up perfectly with how sensitive an asset is to each of those risk factors. Any deviation gets traded away. Now, the real beauty of this was its flexibility. Unlike the old models that put all their eggs in one basket, that single, unobservable market portfolio, APT said, hey, there could be multiple sources of risk out there. It gave us a much more nuanced and testable view of the world. You didn't need to know what was in everybody's head. You just had to believe that people don't like leaving risk-free money on the table. Okay, so arbitrage seems like a much stronger foundation for pricing assets. It's flexible, it's less demanding, but it's not a silver bullet. And understanding its limits is where things get really, really interesting. Because we have to stop and ask a very practical question. Out here, in the messy, complicated, real world, is arbitrage ever truly 100% riskless? Is it really as simple as just picking up a free lunch? Well, the answer, of course, is no. The kind of arbitrage you read about in textbooks is a bit of a fantasy. In reality, you need capital to trade. You have to finance those positions, often by borrowing money. And this is the big one, a price that's wrong can always get more wrong before it gets right. As the old saying goes, the market can stay irrational a lot longer than you can stay solvent. And that really sums it up perfectly. Arbitrage definitely pushes prices in the right direction. It's a powerful disciplining force in the market. But that force isn't magic, it's not instantaneous, it works slowly, imperfectly, and sometimes it can get completely overwhelmed. So if the very people who are supposed to be correcting these mispricings are themselves constrained, what does that mean for the market? This brings us to the really profound consequences of the limits to arbitrage. It means that these weird price anomalies aren't just little blips that disappear in a second. If the traders who see the mistake are worried about losing their funding, or if they're facing margin calls, they might be forced to close their positions, even if they know they're right in the long run. I mean, we saw this in 2008. There were clear mispricings all over the place, but the people who could have fixed them were either out of money or just too terrified to act. And their inaction can actually make the problem even worse. So let's just put these two side by side for a second. The difference is stark. In theory, you've got this army of all-powerful traders who instantly zap away any mispricing. But in practice, you have a world of capital-constrained, risk-averse people whose ability to discipline the market is imperfect and can completely break down under stress. And this leads us to a kind of uncomfortable conclusion. That simple, powerful idea that just the absence of free lunches is enough to keep markets efficient, well, it starts to look pretty fragile. Discipline is absolutely necessary for efficiency, but it might not be enough. So we're left with a new, much deeper question. If this powerful force of arbitrage is limited by real-world constraints like capital and financing, what's left? What is it that truly anchors market prices to reality? If it's not just about risk-free trades, then maybe it's about the balance sheets of the traders themselves. And that, well, that opens up a whole new chapter in the story of modern finance.